the Monetary Policy Committee, risks to the outlook have increased against the backdrop of a slowing Chinese economy. These risks, in conjunction with the continued capital outflows from emerging markets, have resulted in heightened global financial market volatility and contributed to the decision by the US Fed to maintain its current monetary policy stance. This delay has added uncertainty to an already volatile global setting. The domestic economic outlook has deteriorated following the surprise contraction in the second quarter of the year. At the same time, the rand experienced further significant depreciation in response to domestic and global developments, intensifying the upside risks to the inflation outlook. The combination of sharply slowing growth and rising inflation compounds the dilemma facing monetary policy. The year-on-year inflation rate, as measured by the Consumer Price Index, CPI, for all urban areas measured 5.0% and 4.6% in July and August, respectively. The increase in the inflation in August was mainly the result of changes in the housing and utilities and transport indices. Having reached a recent high of 5.8% in January and February, the bank's measure of core inflation, which excludes food, fuel and electricity, measured 5.3%, down from 5.4% in July. Producer price inflation for final manufactured goods increased from 3.3% in July to 3.4% in August, down from 3.7% in June. The upward trend is expected to continue in the coming months as the impact of higher agricultural crop and food prices become more apparent. The inflation forecast of the bank has changed marginally, with a near-term improvement and a slight medium-term deterioration. Inflation is now expected to average 4.7% in 2015 from 5.0% previously, and then to breach the upper end of the target range in the first quarter of 2016 with a peak of 6.7%, previously 6.9%. Inflation is then expected to be around the top end of the target range with a further temporary breach of 6.2% in the final quarter. The breach is mainly due to base effects from the lower starting point for the petrol price in the fourth quarter of this year. The forecast for 2017 follows a slow downward trend, with inflation measuring 5.7% in the final quarter. The changes in this trajectory are mainly due to the more depreciated starting point for the real effective exchange rate, which is offset to some extent by lower international oil prices. The forecast for core inflation is marginally higher in the later quarters, but with an unchanged expected average of 5.4% in 2016 and slightly higher at 5.3% in 2017, up from 5.2%. Inflation expectations as measured by the survey conducted in the third quarter by the Bureau for Economic Research are more or less unchanged and remain at the upper end of the target range. Average inflation expectations for 2016 are unchanged at 6.1% and reverted to 5.9% for 2017, following the decline to 5.8% in the previous quarter. As before, there were marked differences between the different categories of respondents, with the 2017 expectations averaging 5.4% for financial analysts, 6.5% for business people, and 5.9% for trade unionists. Average 5-year inflation expectations declined from 6.0% to 5.9%, but those of business people reverted back to their 2014 level of 6.5% from 6.3% previously. The median annual expectations of market analysts, as reflected in the Reuters Econometer survey, are almost identical to those of the bank's forecast and more or less unchanged since the previous survey. The break-even inflation rates derived from inflation-linked bonds have increased moderately since the previous meeting and have remained above the upper end of the target range across all maturities. The global economic outlook has become more uncertain since the previous meeting of the MPC, driven in part by the strong financial market reactions to the deteriorating outlook for the Chinese economy. Although the growth prospects in the US remain positive, they have been clouded by growing concerns about possible spillbacks from a slowdown in emerging markets, particularly in China, as well as from the impact of the strong dollar. Euro area growth moderated in the second quarter and remains relatively subdued, whilst real output in Japan has declined. Growing concerns of the risk of an abrupt slowdown in the Chinese economy have been fueled by excess capacity in the real estate and the industrial sectors of the economy. The recent equity market correction, the surprise devaluation of the renminbi, and the uncertain policy responses have added to these concerns. While to date the actual slowdown has been relatively moderate, a hard landing could have a severe impact on global markets and on commodity prices in particular. These developments have had an adverse effect on the outlook for commodity producers, particularly emerging market economies. But Asian economies with close trade links with China have also been affected. The deteriorating terms of trade have compounded the impact of continued capital flows from emerging markets in anticipation of US monetary policy normalization. Consensus growth forecasts for most Latin American and Asian economies have been revised downwards. Lower commodity prices have contributed to a more benign global inflation environment, although some emerging markets are experiencing inflationary pressures through depreciating currencies. In the United States, concerns about possible restraining effect of the appreciating dollar on domestic economic activity and inflation, coupled with global financial market volatility and the risks of a sharp slowdown in emerging markets, were key factors in the decision to delay the commencement of monetary policy normalization. The ECB has indicated that further monetary easing is being contemplated, while developments in Japan suggest that monetary policies will remain highly accommodative for some time. Domestic financial markets, including bond and equity markets, have not been immune to the turmoil in global markets. Although the rand has been one of the more volatile currencies, having fluctuated in a range of between around 12.60 and just over 14 rands against the US dollar since the previous MPC meeting, its trend depreciation over the year has not been significantly different to those of other commodity currencies and a number of other peer emerging economies. Since the previous meeting of the MPC, the rand has depreciated by about 9% against the US dollar, by about 10% against the euro, and by about 8% on a trade-weighted basis. The rand was negatively impacted by developments in China, continued speculation regarding the timing of US policy takeoff, and the weaker than expected GDP growth outcome. The rand reacted positively to the US decision to maintain its policy stance, as well as to the narrowing deficit on the current account of the balance of payments. The rand exchange rate remains an upside risk to the inflation outlook. As noted in previous statements, a key uncertainty for the MPC is the extent to which the US policy normalization is already priced into the currency. The fact that the rand appreciated in response to the Fed decision suggests that some depreciation is likely when US rates are increased. However, the extent is uncertain, with the possibility of a temporary overshoot in a highly volatile environment. A further uncertainty relates to the sustainability of the contraction in the current account of the balance of payments in the second quarter, when a deficit of 3.1% of GDP was recorded. While this narrowing is attributed in part to temporary factors, there appears to be some evidence that both export and import volumes are responding to the depreciation of the rand and the weaker economy. However, the bank expects this process of adjustment to remain slow, with export response inhibited by a number of factors, including headwinds from the slowing global economy, electricity supply constraints, and declining tourism receipts. The domestic economic growth outlook deteriorated compared with the previous forecast. This follows the surprise annualized contraction of 1.3% in the second quarter of this year. While the MPC is of the view that a further contraction is unlikely in the third quarter, the outlook remains weak amid declining business and consumer confidence. The bank's forecast for growth has been revised down by 0.5 percentage point in each of the forecast period to 1.5% in 2015 and to 1.6% and 2.1% in the subsequent 2 years. The bank's estimate of potential output for 2015 has also been revised down to 1.8%. The risks to the growth outlook are now seen to be more or less balanced. This weak outlook is consistent with the bank's leading indicator of economic activity, which has exhibited a more pronounced downward trend in recent months. The growth disappointment was particularly evident in the goods-producing sectors of the economy, with contractions in agriculture, mining, and manufacturing, although growth in services sectors also moderated. The agricultural sector remains constrained by continuing drought, and although mining output increased in July, prospects are being negatively affected by weak commodity prices, lower global demand, and the risk of industrial action in parts of the sector. Manufacturing output also increased marginally in July, but the decline in the Barclays PMI to below the neutral 50 level in August and a further decline in capacity utilization suggest a challenging outlook. Growth in gross fixed capital formation moderated to 1% in the second quarter, with general government providing the only notable increase. The weak contribution from the private sector is reflected in the further sharp decline in the RMB BER Business Confidence Index to its lowest level since 2011. The only area where private sector investment increased markedly was with respect to energy generation projects. This disappointing scenario does not bode well for employment growth, despite the decline in the official unemployment rate to 25% in the second quarter, mainly due to growth in informal sector employment. Growth in consumption expenditure by households also reflects the subdued demand conditions in the economy, with a moderation in growth to 1.2% in the second quarter, with some resilience only evident in semi-durable goods consumption. Retail sales grew only marginally in July amid a sharp decline in business confidence of retailers. The weakness in durable goods sales is evident in the lower new vehicle sales in August, particularly commercial vehicles. Consumers are expected to remain constrained against the backdrop of slow employment growth, declining disposable income, and rising inflation. Furthermore, The pace of credit extension to households, which remains negative in real terms, is expected to be impacted further by the tighter affordability criteria following the implementation of amendments to the national credit regulations. At the same time, household deleveraging has continued, with the debt to disposable income ratio moderating further to 77.8% in the second quarter of 2015, its lowest level since 2006. Credit extension to the corporate sector, by contrast, has been buoyant, particularly with respect to general loans and mortgage advances. New data concerning wage and unit labor cost developments have become available. No new data concerning wage and unit labor cost developments have become available since the previous meeting of the MPC. But trends are expected to be relatively unchanged, with average nominal wage growth in excess of inflation contributing to the persistence of inflation at higher levels. Although food price developments have been relatively benign, they remain a concern to the MPC, with the expectation of an acceleration in the coming months as the impact of the drought feeds through to consumer prices. This is despite the favorable impact of falling prices at the global level. Domestic food price inflation at the consumer level appears to have reached a low point of 4.3%, increasing marginally to 4.4% in July and August. The pressures are expected to come from the drought-induced increases in agricultural price inflation for cereals and crops, which increased at a year-on-year rate of 38.7% in July. The recent decline in international oil prices has provided some respite to inflation pressures, with the price of Brent crude oil currently trading at around $10 per barrel, lower than at the time of the previous MPC meeting. The current global oversupply of crude oil, coupled with the slowdown in China, is expected to keep oil prices contained in the short to medium term. The MPC revised down its oil price assumption by between $3 and $4 per barrel in each of the coming years. However, the committee assesses the risks to the oil price assumption to be on the downside, particularly in the short term. The domestic petrol price declined by a cumulative R1.20 per litre in August and September, and current trends suggest that no significant change is likely in October, with the weaker rand offsetting the impact of the falling dollar price of oil. The inflation outlook remains a concern for the Monetary Policy Committee, with risks to the forecast assessed to be on the upside. Although 2 breaches of the target are now expected in the first and fourth quarters of next year, they are expected to be temporary and primarily the result of base effects from lower petrol prices 4 quarters previously. Nevertheless, the MPC is concerned that the longer-term inflation trajectory remains uncomfortably close to the upper end of the target range. And given the upside risks to inflation, the probability of a more extended breach than currently forecast is relatively high. A sustained breach of the target range has the danger that it could impact negatively on inflation expectations, which are currently sticky at the upper end of the target range. The MPC is concerned about domestic growth prospects, with the economy contracting in the second quarter. Growth is expected to remain constrained by global developments and associated uncertainty and volatility, low business and consumer confidence, and electricity supply shortages. Domestic inflation is not driven by demand factors, and the outlook for household consumption expenditure has deteriorated. However, we have to be mindful of the second-round effects of supply-side shock on inflation. There are a number of upside risks to the inflation outlook. The primary one being the exchange rate, which has already depreciated significantly against the advanced economy currencies in response to global developments and is likely to react further to the commencement of US monetary policy tightening. A further risk emanates from possible higher multi-year increases in electricity tariffs from the middle of next year. Downside risks to the inflation outlook include international oil prices, should they be sustained at current levels. In addition, weak domestic demand may continue to constrain pricing power in the economy. The committee, nevertheless, assesses the overall risks to the inflation outlook to be on the upside. As noted in previous statements, the MPC has to achieve a fine balance between realizing its core mandate and not undermining short-term growth unduly. The NPC has decided unanimously to keep the repurchase rate unchanged for now at 6% per annum. The MPC remains on a gradual policy normalization path. The committee will continue to monitor developments closely and will not hesitate to act appropriately should the risks to the inflation outlook deteriorate materially. As before, any future moves remain highly data dependent. Let me at this stage invite questions from the members of the media here present, and as usual, please identify yourself and the media house that you represent, right here in the front.
Thank you, Governor. It's Mariam Issa from the Sunday Times. People from the Federal Reserve sometimes or often give guidance on this. I wonder if the Reserve Bank's MPC could tell us whether a rate hike is now more likely to wait until next year, the next rate hike, or whether given the really weak growth outlook and so forth, whether it's now more likely to be next year than towards the end of this year.
The rate hike in the US or in South Africa?
Sorry, in South Africa. Or both.
No. If it is in South Africa, you know that the next MPC is in November. So if you want to know what would happen in November, I suggest you wait until the November MPC. There was another hand in the second row. Yes, ma'am.
Thanks, Governor. It's Hannah Barry from MoneyWeb. I wondered if you can comment on whether the Reserve Bank is waiting for the US Federal Reserve to make decisions on its rate before you make a move. Thanks.
We did move in July without the Fed. We watch what is happening elsewhere in the world. And our assessment is always based on what is the impact on the South African economy in terms of the economic outlook and growth outlook and inflation outlook. We do not formulate our policy in such a way that we have to move step by step with the Federal Reserve. You know, at that one stage, the Federal Reserve was doing quantitative easing. We didn't have to do that because we were faced with a different set of economic challenges. By the same reasoning this time around, the policy decisions that we take are based on our assessment of the South African economy rather than what the FOMC is doing. There was another hand again in the second row.
Thank you, Governor. Good afternoon. My name is Nzakis Mashangani from Business Day. The cumulative 100 basis points increase in rates since January last year. I see that from your inflation forecast, you're still expecting next year's inflation to be slightly higher. And has it had any effect, the cumulative rate hike, or on inflation? Thanks.
We started the tightening cycle in January last year. The economic circumstances were different. And in July, we took a further step last year. The economic circumstances were different. When we came back in January this year, there had been a realignment of prices in terms of commodities, and more importantly for us was that the oil price had come down. And at the time, some of you even thought that maybe there should be a reversal in policy. And our take was that we have got to look through the cycle. We've got to see that there is persistence in the decline in the oil price. And as we had seen, there was a further adjustment in the oil price. It went up. And although it has come down now, once again, as we said in January this year, we would like to see that there is persistence in the level of the oil price, and that more importantly that there is feed through into domestic price formation process. But bear in mind that monetary policy effect on the economy comes with a lag. At the moment, our estimate is that it is between 18 and 24 months. And the steps that were taken, cumulative 100 basis points, and I guess every time there is a step change in the policy rate, there will be different effects, and those effects will be felt at different times in any case. But then, as we had said now that the risks to the inflation outlook are on the upside, we had identified what are the key risks that could lead to inflation actually rising. And in the forecast that we had presented, which is accompanied by the assumptions attached to the MPC statements, we have spelled out the assumptions that are underpinning the forecast. And if those things change, we will assess the situation as data presents itself, and we will be ready to act appropriately. What has the effect been so far? Time will tell. We will have to see how that plays itself out with the data. Still on the second row.
Well, there we have it. Repo remains unchanged at 6%. We'll unpack the outcome just after this break with, as usual, we've got two economists in the studio. But first, let's take a break.
SABC brings to you Rugby World Cup 2015.
Opinion or your comment on that?
You know that there are more economists working in the Reserve Bank than out there. So I have got a bigger battalion of economists. So you can imagine how many views I have to make sure I balance when I am here. The decision that we have taken in July was a correct decision, just like the decisions we have taken previously were the right decisions, just as the one that we have taken today is the right decision. And it's because every decision that we take is underpinned by very rigorous analysis of the state of the South African economy where we are now, and the outlook for the South African economy. And as you seen in the MPC statement, we expect that we would be out of target for at least 2 quarters in the next year. And I think that in one of the quarters we will be bang just around the upper end of the target range. So the nice thing about being a private sector economist is that you can change your view every time data is released. Whereas if you are in the MPC, you have to wait every 6 to 8 weeks before you can change your decision. We have got very rigorous analysis taking place in the Reserve Bank, and we have got no doubt that the decisions that we have taken are in the best interest of the South African economy. Right at the back.
Good afternoon, Governor. In your previous inflation forecast, you indicated that you factored in a 13% electricity tariff. Are you still factoring that particular increase going forward? Is electricity tariff still a concern for you? And the second one is the inflation risk emanating from drought. There seems to be a lag. How soon, in terms of your assessment, can we expect that to come through?
Electricity tariff increases, yes, we are still the outlook that we have is still based on that 13%. In as far as the new multi-year price determination is concerned, we can't form a view until NERSA pronounces on that decision. And that, I guess, will be sometime next year. As you heard in the MPC statement, we said that there are still risks when the increases kick in July next year. So we will wait until we hear what NERSA had actually decided. Inflation risks from the drought conditions. We had seen that coming through in the figures that were released today. We have seen that grain prices are rising in double digits. I think around 38% it was, and so naturally, when something like that happens, you look at it and you say that this is a supply side shock, and you try to look through it and see whether it fits through into other prices. The thing with grains is that it is also the feedstock. Grains are feedstock, and if they are feedstock in the production of poultry and other meat products, then it poses different risks. How long would this thing take? We are not sure, but what we have done is to take what we know and build it into our forecast. So our forecast will reflect what we already know about trends in domestic food prices. Yes, sir, and then another one in the middle.
Afternoon, Governor. TJ Stradom from Reuters. Was the MPC surprised by the GDP contraction?
The statement does say we were surprised.
But were you very surprised? Actually, the question is, how surprised were you?
Remember that the previous statement expected that we would still be having growth. We had still penciled growth in the second quarter, so we were surprised that it actually ended up being a contraction. There is one that side, and I'll take one from the webcast. I know the future governors here wants to help me answer the questions. I will take the questions and then I'll distribute them to the future governors just now. Yes, ma'am.
I'm Gelang Bata from Bloomberg News. Governor, given the rand's significant depreciation, to what extent are you concerned about the rand levels, and at what point would you consider market intervention?
I think this time I must take another one. Webcast.
It's a question from Daniel Imasia. What does the MPC make of the moderation in services CPI? It has recently subsided to 5.6 following a long period of stickiness around 6. The housing market seems to be behind some of this moderation. Could it continue exerting downward pressure on CPI, especially in light of poor credit growth?
Are we concerned about the level of the rand? No. Are we concerned about the rapid movements in the currency and the uncertainty it enjoys? Yes. Would we consider intervening in the market? Well, we have got a very good track record of intervention as a central bank. And in all the interventions that we have made, the result has been the same. And it had been that no central bank can ever stand in the way of a currency that the markets believe is fundamentally deviating from economic fundamentals. So if the currency is responding to economic fundamentals, no amount of central bank intervention, no matter how much reserves it has, would it be able to stem that correction. But in your question about intervention, you seem to be worried only when the rand weakens. Shall we remind South Africans that when the rand was strong, South Africans were also complaining about it at that time. So if you couldn't correct it on the other side, what makes you think you can correct it on the other side through intervention? And as far as the foreign exchange market is concerned, we will get consent if we feel that the price discovery process in the foreign exchange market have been impaired as a result of development, those kinds of developments. But at the moment, the foreign exchange market is functioning just fine. What do we make of services inflation? Well, inflation is inflation. We look at the entire CPI basket. We don't target food price inflation. We don't target goods inflation. We don't target services inflation. We target the overall level of inflation. There is one question here, and that looks like that will be the first question to be answered by the future governors. Miriam?
Thank you. Just to stubbornly go back to my last question, do you think the Fed is likely to raise rates before the end of the year? And secondly, do you think that in a way it would be a good thing for the Fed to get it out of the way so markets stop speculating and stop being so volatile?
The Federal Open Markets Committee is in the best position than any one of us to assess what is in the best interests of the U.S. economy. And I am sure that after they have assessed, they took a decision that is in the best interest of the U.S. economy and will continue to do so. Should the Fed get done with it and get it out of the way? Well, that presumes that after they have taken their first step, that would be the end of the road. There will always be another FOMC meeting, and at every FOMC meeting, you will be asking the question, are they going to do it or are they not going to do it? But they are in the best position to tell whether the steps that they are taking are the correct ones. And actually, I will get very worried if they start commenting, if the FOMC starts commenting about the decisions of the MPC in South Africa. Ma'am? Yes.
Thank you very much, Honorable Governor.
Your name?
My name is Agnes Khakala from Albert Moroka Grade 12. On a lighter note, we know that the South African Reserve Bank is an independent body. But when we made our research, we found out that the South African Reserve Bank was waiting for Fed to respond in order for them to make decisions regarding the repo rate. So does that show their independence? Thank you.
That is not a light note, it's a very difficult note. Yes, we act independently. We are a central bank of a small open economy. And as a central bank of a small open economy, developments that take place elsewhere in the world impact on our economy, including the decisions taken by the central banks of the advanced economies. The manner in which we respond is not because they have done something, therefore we do, or they didn't do something, therefore we don't do. So you would realize that in July we took a step to adjust the policy rate. We didn't have to wait for the Fed or follow the Fed. In the end, the decisions that the Monetary Policy Committee of the South African Reserve Bank has to take have got to be decisions that are in the best interest of the South African economy. Another governor? Yes, ma'am.
Thank you, Governor. I am Mosa Selwani from Albert Moroka High School. Governor, Honorable Governor, why did the MPC not stimulate the economy? As there's a high unemployment rate, it is currently 25%, and there are also low levels of consumer confidence, and the business confidence also declined. So that, and the economic growth also, it has declined in the second quarter to 1.3%. And in our economy, in order for us to see that the economic growth rate, it is satisfactory. We only consider it to be satisfactory when it has grown by 5%. So why did the MPC not stimulate the economy through the expansionary monetary policy?
Monetary policy is still expansionary at the moment. On a projected basis, the repo rate is just only marginally positive. That continues to give support to the economy. The challenges of unemployment and economic growth in South Africa are not of a cyclical nature. There is a small cyclical component into it. They are of a long-run structural nature, which then suggests that the appropriate response by the South African policymakers is to embark on a process of microeconomic reforms, a structural change that would raise the long-run growth rate of the South African economy. Whereas monetary policy could affect growth, it only affects growth on the cycles. It will not change the long-run growth trajectory of the economy. Webcast.
Sorry. Question for Kuben from Peter Montalto. Core CPI is surprised to the downside risk to the downside in the past few months. How much do you think that is due to your previous rate hikes, to unit labor cost growth slowing, or to lower growth? Thanks.
Kuben, you have got a fan in London.
Good afternoon, Mr. Montalto. We are quite encouraged and pleased that CPI is falling. I think, core CPI is falling. Core CPI is falling for a number of reasons. The second round effects of lower oil prices. But we think the main reason why core CPIX is weak is largely because of the weak state of the economy. Consumers, retailers, producers, wage setters, even unionists cannot afford to extract the price increases that they would normally do in a rapidly growing economy. So we're encouraged by the fact that core CPI is safely within the target. And yes, the 100 basis points, the cumulative 100 basis points increase that we have had over the past 18 months must have had some effect, even if it's marginally, to support that process of keeping core CPI within the target. Having said that, we don't target core CPI, we target headline CPI. We look very closely at the core CPI because elements like petrol, electricity, and other cyclical elements are highly volatile. Food prices are highly volatile. So we do look quite closely at core, but that's not what we target. We target the headline CPI.
Any other questions? That shall be the last question.
Thank you, Honorable Governor. I'm Khwitsman Shani from Albert Mwaka. My question is based on, he talked about high unemployment in South Africa. Would you suggest interest rates, as they've been fairly stable, as an effective instrument to combat high unemployment?
Interest rates is just about one tool of economic policy. And from a monetary policy perspective, actually almost like the only tool that we have. Like I spelled out earlier, for you to deal with unemployment, you have got to take the difficult structural changes that are necessary to make sure that jobs are actually created. You can't think that you can take this one instrument called interest rates, that you are going to use it to control inflation, to grow the economy, to combat electricity tariffs, to combat oil prices, to do all of that stuff. You cannot use one instrument to achieve a multiplicity of objectives. So what have we been tasked with as the South African Reserve Bank? We have been tasked with protecting the value of the currency, the rand in your pocket. That is our task. We must protect that. But in doing so, we must do it in the interest of balanced and sustainable growth in the economy. When you are in a situation where you are having inflationary pressures building up in the economy, your economy is not in balance. And if you are to live up to your constitutional mandate of protecting the value of the currency, in ensuring that there is balance and sustainable growth in the Republic, that is exactly what you would have to do. That concludes today's press conference. Thank you very much for your attendance. We will see you in November.